This week's red-hot read on inflation intensifying the debate over how many times the Fed will need to raise interest rates this year. Our next guest clearly has views on that. Jeffrey Gundlach is the CEO of DoubleLine Capital. He joins us now in a CNBC exclusive interview. Jeffrey, welcome back. It's great to see you.
Nice to be with you, Judge. Happy Super Bowl weekend.
Yes, and to you as well. I know you wish your Bills were here. It worked out differently, unfortunately. But let's talk about the question of the moment in the markets. How many times the Fed will need to raise interest rates and by how much? You heard the Bullard comments yesterday. The market is now seemingly pricing in 50 basis points in March. At least the probability of that is creeping higher. What is your view?
I don't think the 50 basis point probability that's you could calculate using the yield curve, I don't think it's high enough right now for the Fed to actually go 50 in March. It's getting close. Usually, I mean, we've talked about this for years, Judge. I mean, the Fed just follows the bond market. I've made almost jokes about this in my webcast, that all we need is the 2-year Treasury. We don't really need the Fed, because if you plot out the Fed funds rate relative to 2-year Treasury, it's almost a perfect relationship. So right now, the 2-year would probably have to go another 25 basis points higher or so by the meeting for them to go 50. But of course, it's a guarantee that they're going to raise rates, whether it's 25 or 50. I'm going to, at the present moment, bet on 25, but I do think there's about a 1/3 chance that it goes 50. But it looks like the Fed's going to raise rates perhaps 5 times this year, which would take the 2-year, the Fed funds rate up to a little bit over 1.25. And it's interesting that the tremendous flattening of the yield curve that we've seen since March of last year has slowed down a lot, which feeds into the idea that I've been toying with, that the yield curve is going to once again flatten at a lower level than any other time since about 40 years ago. This has been the pattern. And so we're starting to get some recessionary indicators and some recessionary views, which last time we spoke, Scott, there was just nothing about recession. It was all about stimulus. But as we talked about, what's been feeding everything is the stimulus. And it's very odd that we're talking about perhaps 5 interest rate increases and you're querying me about a 50 basis point hike at the next meeting at the same time as the Fed is still doing quantitative easing. It's really kind of remarkable. I think the Fed should have stopped quantitative easing not next week, not tomorrow, not yesterday, but a year ago. And what we're seeing is the consequence of all this excessive stimulus. Judge, we talked about this back in the lockdown in 2020, back in March or April, that all of this crazy stimulus was going to have inflationary impacts. And we were very hawkish on inflation entering 2021 at DoubleLine, but nobody was hawkish enough. I mean, we were so audacious as to say we might get a 5 handle on the CPI. Well, it's now 7.5. And 7.5, I don't know, maybe it's just me, but 7.5 sounds a lot higher than 7 from the 1 month ago. I mean, 7.5 sounds like we're headed towards double digits. I've been talking about how I feel young again because I grew up with Jimmy Carter. And so many of the things that I remember from being a teenager or a young pre-teenager even are sort of looking the same. And that has a lot to do with markets as well. So we're looking at kind of the similar situation, but almost in the mirror. I mean, interest rates are so incredibly low. They're super negative on a real basis. They were super negative on a real basis on Jimmy Carter, but they were at much higher levels. So it's not surprising that markets are having trouble because they've all been predicated on the enormous stimulus, which is obviously being taken.
It's interesting to hear you, Jeffrey, push back on Bullard in the manner I feel that you are. Do you think that 5 rate hikes will be enough? Can the Fed engineer a soft landing? Can they land the plane softly?
I've never seen it happen before. I mean, every time you get into this sort of an environment, you start to hear people talking about this time it's different. And I'm hearing that a little bit now already. Well, rates are still really low, so it doesn't matter. I heard somebody who was a mortgage broker on a radio program yesterday talking about how who cares if rates are up? They're still really low. But that's really a bad analysis. And when rates go up, it has an impact. So I think the Fed's going to have to raise rates more than the market still thinks. I think we're now priced ultimately for a terminal Fed funds rate of around 1.5, maybe 1.75. My suspicion is they're going to keep raising rates until something breaks, which is always the case. And so we're starting to see more recessionary indicators. We got consumer sentiment today, which is always one of the best leading indicators of recession, and it looks absolutely horrible. The Michigan consumer sentiment is down at 61, and the view of the future is absolutely tanking. And this is one of the few indicators that was prescient about the exogenous shock of COVID. I mean, that was the one indicator that was looking recessionary in the first quarter of 2020. And so that's not looking very good. The yield curve is now has us on watch already. Once you get 2s, 10s, this yield between the 10-year Treasury and 2-year Treasury inside of 50 basis points, you're on recession watch. And that's where we are. It's not very far inside of that. So we have a little bit of relaxation, but also 5s, 30s. The yield between the 5-year Treasury and 30-year Treasury is also inside of 50 basis points. And that's puts you on some probability of recession. So with the combination, the double-barreled raising of short-term interest rates and ultimately the winding down of quantitative easing, and I think they're going to go into quantitative tightening. Last time we saw this movie, it was in the fourth quarter of 2018. And it's hard to remember because it went by with a blink of an eye, but we had a bear market in the fourth quarter of 2018 in equities. And, the NASDAQ's down 10% year to date. The S&P's down 5%. And I've noticed that global stocks are outperforming. Even emerging markets are starting to outperform. This is a theme that I've been recommending really going back since the middle of 2020. So, yeah, I think we're looking at some economic stress. My friend Dave Rosenberg speaks very eloquently about the huge fiscal drag that we're already experiencing. As much as the deficit is exploding still, the deficit percent of GDP is contracting from that ridiculous level of 2020, about 20% of GDP, down to now only with air quotes, 15% of GDP. But that's a big fiscal drag. So we're starting to see a lot of, let's go Jimmy Carter again, even though he didn't use the word malaise in the official crisis of confidence speech, it was quoted as a malaise speech. And we're seeing that. The other thing about inflation is everybody wants to point to supply chain problems. But with this trucker thing going on, we've got an extended supply chain problem. I mean, Canada's our biggest trading partner. And that bridge that the truckers have shut down, it carries about half as much as all of those boats that were so famously photographed off of the ports of Los Angeles and Long Beach. So I think one thing we can all agree on is inflation just continues to surprise on the upside. The Fed is obviously behind the curve. Even the Fed officials are acknowledging it, and they're just going to have to keep talking and acting more hawkishly, which is always problematic for risk assets, as real yields have been rising until very recently. So it's a tough environment. There's no one's making any money.
You don't expect that some of the inflation, and I'm not specifically talking about energy prices or wages, which are certainly likely to be more sticky, but you don't expect that some of these inflationary pressures are going to ease as you move further away from the pandemic, as we finally appear like we're nearing its end. You don't expect that inflation is going to start to come down?
No, I do expect it's going to come down, but I think it's going to be disappointing, the pace and the degree to which it comes down versus those that, want to say it's going back to 3 or even 2%. Yeah, I mean, like lumber prices are probably peaked. Housing is going to start having problems with prices being so high. I mean, most people don't realize that the median home price in the United States is up 30% over the last 2 years. People always look at the year over year, but the 2-year number is 30%. And now mortgage rates on the 30-year conforming are at 4%, which doesn't sound very high. But when you have a market that's priced for 3% or even 2.75%, that's a problem. So yes, some of the commodity prices are likely to ease, but they're going to be replaced with, as you suggest, wage growth increase. And also on the CPI, the shelter component is grossly understated versus what's actually happening with rents, which are up double digits and unlikely to relax. And obviously, I just mentioned single-family home prices. So there'll be a rotation of what's driving the inflation. But I'm just at this point, I think the trend is your friend. How many months in a row, Judge, has it been that the CPI has printed well above expectations? Most months it's above the highest forecast. And as I said, we've been very hawkish on inflation, more than almost any other firm in the investment business, but not nearly hawkish enough. It just keeps exceeding our forecast. We think that inflation is very likely to print at least 5% for 2022, which is way less than 7.5%, but it's a great distance away from a 2% plus a little bit 10-year, a zero Fed funds rate. All of these things are completely out of sync. One of the things we like looking at and have done so for years is the ratio of the price of copper to the price of gold, which is a great starting point to think about where the 10-year Treasury yield maybe should be. For years, they were right on top of each other until the pandemic came, and then the copper-gold ratio blew higher, with copper going way up and gold not doing much of anything. Of course, the 10-year Treasury yield was suppressed. So virtually every indicator, we have a litany of them at DoubleLine, suggests that the 10-year Treasury under normal market conditions should be probably 100 basis points higher than it is right now. And the normal market conditions, the base case, based upon Fed rhetoric, particularly Bullard, is that they might be entertaining the idea of letting normal market forces take place. So interest rates are going higher. Every risk asset has to reprice based upon these higher interest rates, and it's a process where capital preservation becomes important. I've been recommending non-U.S. investments relative to U.S. They've started to outperform, particularly in equities. The best performing sector this year, strangely, is emerging market equity. And the reason I say strangely is that emerging market bonds are not doing well at all. So it's interesting that emerging market equities are catching something of a bid, even with the dollar not falling, which is going to happen ultimately. So European equities are outperforming as well, particularly the UK, which we turned bullish on a few weeks ago. So it's really a rotation away from what was the beneficiary of all of the excessive stimulus, and that's in the process of repricing. And I think it has a ways to go.
And I do recall when we last spoke in October, you had told us and our viewers that for the first time in the firm's history, you were overweight European stocks versus the United States. Let's do this, Jeffrey. I'm going to take a quick break. When we come back, certainly want to talk more with you about the markets. We'll be right back with DoubleLine's Jeffrey Gundlach. We are back now with Jeffrey Gundlach. He is the CEO of DoubleLine Capital. It is a CNBC exclusive interview. Jeffrey, we've talked a lot about the Fed, obviously, and we've talked about rates. I want to talk to you a bit about the markets, which have been behaving pretty well. I think you would agree. It's not like, credit spreads are blowing out or anything like that. They've been behaving pretty well. Yes, the stock market has had some upset to it, but it's also proven to be pretty resilient. I'm wondering what you think on both accounts.
Well, credit spreads are quietly widening, and I think it's more than a lot of people are aware of. I mean, I mentioned earlier that emerging market debt is down pretty sharply, and it's down 5-6% year to date. We're 5 weeks into the year. We're down 5-6%. And last year, emerging market debt was also negative of some significance on an index basis. So that's widening out. What's holding in are floating rate credit spreads, because people are, wagering on this Fed trend to higher interest rates. But when you look at investment grade corporate bonds, they've widened now by, 20 basis points or so from their tights. I agree with you. It's not a lot. High yield bonds have been reasonably resilient, and stocks aren't down all that much. I agree. I remember back when there was a lot of turmoil that was starting to brew, whether that was I'm not sure if I'm talking about 2018 or early in 2020, we talked about how sloppy things were getting. And I said, this is not sloppy. This is not panic. This is the prelude to panic. And unfortunately, I think that's where we are right now when it comes to credit spreads. Credit spreads are like the old from the Sun Also Rises. How did you go bankrupt? Two ways: first slowly, then very quickly. That's how credit markets deteriorate. First very slowly, and then all at once. Because one of the problems that the credit market is facing is that obviously Treasury rates have been rising, and bond returns were negative last year, and they're more negative this year. And so people don't like buying things that are delivering negative returns. And so one has to ask, when the Fed is not buying any bonds anymore, and when they start doing quantitative tightening, and there's not a lot of enthusiasm for fixed income broadly, what's going to stop prices from going down on some of this credit product, which, let's face it, thanks to the Fed's actions, didn't exactly enter 2022 as cheap. So I think we have more spread widening to go, and we all know that when spreads start to widen, you start to have problems in equity. So I think that you're right to say that, yes, there has been no panic. Markets held up pretty well, not exactly the NASDAQ, but certainly Dow Jones isn't bad. And so there's parts of the market that are doing well, but I do think that the obvious tailwind we've talked about for nearly 2 years, Judge, which is this quantitative easing and zero interest rates against a backdrop of escalating inflation, so massively negative interest rates, more negative than under Jimmy Carter. That's a problem when that starts getting taken away, because that's what's priced in. So you have to go to places where you're not being, on a sugar high, where you're not living on massive stimulus. So again, emerging markets are probably a place that I haven't bought emerging market equities yet, but I'm getting close. And I've started to recommend that it's okay to start averaging in, because the relative valuations of things are so out of whack. If you look at the United States, growth versus value, I mean, your value is as cheap as it was in Jimmy Carter day. And these are huge cycles that have massive swings. And value is as cheap now as it was in 1976 versus growth. And you see that you look at not just in the United States, growth versus value, but in developed markets. The PE of growth versus value in developed markets on average is about the same as it was 5-6 years ago. And yet growth is outperformed by 100%. And so we have very extreme valuations, which is never a catalyst. I completely agree with guests on CNBC that say, you can't just go on valuation. I completely agree. But it's so stretched at this point. And one thing that's really interesting is that relentless trend has started to show signs of reversing. You mentioned that I bought European stocks about a little less than a year ago. And as I said in my last appearance, it hasn't really worked versus owning U.S. stocks, but it hasn't not worked. It's almost exactly the same performance going back to the middle of 2020. And since we bought them, actually, European stocks have slightly outperformed. So that incredible trend of U.S. outperforming by 200-300%, some of these other regions, has already shown very significant signs of reversing momentum and starting to favor the non-U.S. investments. And beyond that, the dollar isn't even weak yet. It's holding up on the Dixie index at about 96, with a range of about 95 to 97. It might even push a little bit higher with the Fed raising interest rates, with talk of more aggressive Fed. But once it reverses, and it will, you're going to see the real, the bumper crop of outperformance from these European stocks versus U.S. and emerging markets. This is the main trade that I think investors, I'm not talking about speculators, I'm not talking about for the next quarter, I'm not even talking about for 2022, although I think it will happen in 2022. I'm talking about a multi-year view of where you're going to see sustained outperformance. The dollar peaked in January of 2017 and then double topped under the lockdown in 2020. Dollar trends tend to go for about 8 years. You've probably got, if you start with the 2017 top, you've got at least 3 years where the dollar will probably be weak. And if you use the 2020, you've got perhaps 6 years. So let's just take it in the middle and say you've got sort of a 4 or 5 year window where I think you're going to see this outperformance I'm talking about really materialize. And it's one of these things that's so extreme. It's like where commodities were. Well, I turned very bullish on commodities in the summer of 2020 when they were decimated with the pandemic. They've performed by about 100% since then. That's a huge outperformance, and that's one of the reasons why inflation has surprised to the upside. I'm not really a big fan of commodities right now, not until the dollar starts weakening, because they're up so much. But this is the type of huge move that one can anticipate when these outsized valuation discrepancies normalize.
I love the fact that you're giving our viewers some actionable investment ideas, Jeffrey, in places to look, beyond credit and beyond equities. I do want to ask you about equities, if I may, and because, you have referred back to the pivot that the Fed made in 2018, and you recently tweeted about that and said, quote, it would not be irrational to expect a mirror image market reaction. Now, you've already referred to that period as a bear market for stocks. You've also talked about the 10-year needing to go up by another 100 basis points, so, maybe 3% we're talking about. What is your outlook, at least in the near term, for U.S. equities?
I think in the near term, I would expect stability. The Fed pivot has been so remarkable. In that tweet, I was talking about that incredible pivot to the dovish side. Now we've had almost an historic pivot to the hawkish side, where it was zero forever and quantitative easing seemingly on autopilot. And now it's get out of quantitative easing in a month or two and start raising rates by supersize, as Bullard might have called it. That is priced into the market right now. The market is not going to be surprised by this Fed pivot. It's already happened. And so for that reason, I think we're probably ready for some counter trend movement. Even in fact, yields might even drop a little bit in the near term because they've also been digesting all of this stuff. So we have to see what the March meeting brings. I think until then, I wouldn't be surprised if we had stability in the equity market, and I wouldn't expect weakness in risk assets going into the March meeting.
Oh, interesting. What's the best opportunity you currently see in credit?
Well, it's pretty esoteric. I think you're really looking at securitized products that are backed by cash flows, that commercial mortgage-backed securities. It's pretty esoteric stuff. But I still prefer the floating rate sector, even though I think it's already priced in some of its advantage. I still think the floating rate sectors are good, and that leads you to bank loans, which have held up very, very well, almost too well. But they like the fact they're floating rate, and so some commercial mortgage-backed securities and the like are that way. But broadly speaking, you've got a duration problem in the fixed rate credit market right now, and the spread widening is likely to continue. So I think you have to stay in the shorter maturity and floating rate sectors.
What's your current view of crypto, which we usually talk about whenever you're on with me, and it's had its own upset of late, and it's rebounded very much like other quote-unquote risk assets have as well. Where are you on crypto? What do you own as we speak today?
Well, I've never been long or short crypto. It's just not in my DNA. It's too volatile for me. I remember I met with you last July, and Bitcoin was like at 40,000 or so. And then I met with you again in October or November, and it was up at 60,000. And that's sort of the range. I think Bitcoin, to use the placeholder for crypto, I think it's range bound between about high 30,000s and low 60,000s. And it just moves. It's kind of like owning the NASDAQ on 5 times leverage. That's kind of what crypto is to me. And so it's ultimately, I think, as we move into risk repricing that could be to the downside, crypto will probably be correlated positively with that movement.
I know you don't love these kinds of questions, but I'm going to ask you anyway, because it is really the topic of conversation, and you've opined on the direction of the 10-year. And before I let you go, the end of the year of 2022, the 10-year sits where?
That's so funny because I always push back on that because it's always such a date specific. I remember you asked me that
I know.
Last year, and I said I think it's going to take a peak at 2%, and it didn't take a peak at 2% in 2021, but it's certainly taking a peek at it right now. I think the 10-year will probably make a move towards 250. I believe the curve is going to flatten at a lower level than it did last time, which was at around 3.25. So it's possible the 10-year takes a peak at 3% this year. I'd be a little bit surprised if it does make it all the way to 3%, because it's really the Fed is on the job right now, and we have enough recessionary potential with the flattening yield curve and with the consumer looking really sputtering, is what I would call it, based on consumer sentiment and where prices are and where inflation is. I think the fiscal drag with the consumer not having stimulus, I think the probability of weaker economic activity later this year is pretty high.
Interesting. All right, and before I let you go, who do you like on Sunday?
I think when the Rams signed Von Miller, I very shortly thereafter said I think the Rams are going to win the Super Bowl. And it didn't look that good in the ensuing few weeks, but I expect that you're going to hear the names Donald and Miller a lot. And the question is, can Joe Burrow do his Houdini act, which he certainly did very well in the championship game. But frankly, I think the Rams are going to win by at least 2 scores.
Oh, we hope it's a great game. I know you'll be watching. Jeffrey Gundlach, I appreciate you being with us. It's great to catch up with you, especially now, given what's been going on within these markets. It's
exciting times. What a couple of weeks we've had. Good luck to everybody out there.
No doubt about that. All right. Yep. We'll talk to you again soon. Again, that's Jeffrey Gundlach, the CEO of DoubleLine.